Hi, I'm Wing from TPM Tax Agencies. If your FDI company has just completed 2025 tax finalization in Vietnam, now is the perfect time to review your accounting and tax system. Because in 2026, significant change in tax and accounting regulation will directly affect your financial statement, tax obligation, and risk management. In the next few minutes, I'll walk you through 5 key risk areas every FDI company should review to ensure compliance and minimize unexpected exposure. 1. Related party transaction main risk focus. Why it matters? Related party transactions are a top of priority for tax authority, with stricter rule effective July 1, 2026 under the new tax administration law. What to check? Transfer pricing must follow arm's length principle. Documentation, pricing analysis, valuation methods, market comparison should be complete and logical and up-to-date. Review internal benefits, back-office service, royalty, and group management fees to avoid revenue or cost adjustment. 2. VAT and export services. Why it matters? VAT rule and export service classification were clarified from 2025. Key point: VAT 0% applies only if services are consumed outside Vietnam, with proper invoice and payment evidence. Misclassification or incomplete documentation can lead to VAT reassessment and penalties. 3. Contractor Tax, FCT and withholding compliance. Why it matters? Foreign contractors and suppliers must comply with updated VAT and FCT rule. What to review? Correct identification of taxable entity and withholding rates. Ensure invoice from foreign suppliers comply with electric and VAT invoice requirement. 4. Personal income tax, foreign expert and senior staff. The 2025 PIT law, effective 2026, update calculation, withholding, and finalization for foreigner employee and technical expert. What to review? Classify taxable income correctly, salary, allowances, and non-regular income. Ensure proper withholding and filing, including supporting documentation for exemption where applicable. 5. IFRS and VAS, financial reporting. Why it matters? Vietnam is moving toward using IFRS instead of VAS. Difference between these standards can lead to difference in profits, cost, and tax. What to review? Check the difference between VAS and IFRS in how to you record revenue, expense, provision, asset, and liability. Make sure your reports are consistent if you report to your parent company under IFRS while still preparing local report under VAS as required. Potential impact. If accounting policies are not consistent, it can affect corporate tax, contractor tax, PIT, and financial report, and may lead to compliance risk. Here are 3 steps to minimize risk in 2026. First, regular tax health check. Review accounting and tax data at least every 6 months. Second, evidence standardization. Ensure all transactions with the parent company have real supporting documentation, not just invoice. Third, update Decree 132. Adjust loan agreement and internal service fee properly according to new regulation. Early review ensures sustainable operation, reduce the risk of reassessment, and protect your company profits and reputation. For detailed guidance or assistance, contact TPM Tax Agency via our website or hotline. Thank you for watching and see you in the next video.